With so much going on in the markets and the economy today, from the Fed, rising rates, inflation, and potential economic downturn on the horizon, this next discussion will offer key insights into the U.S. and global economy, and we'll see where opportunities across financial markets and the state of asset management industry broadly. Hopefully, Mona and George will dive into the Fed meeting and the rate decision that just took place as well, the 25 points. And we will hopefully hear from them as well on a few pearls of wisdom or career advice they might offer to those just starting out in the business. For our speaker, it's my distinct pleasure to introduce Mr. George Gatch, CEO of JP Morgan Asset Management. With over 30 years of experience in the financial services industry, George has a wealth of knowledge and expertise in asset management. He's responsible for overseeing more than 2.5 trillion, that's with a T, in assets, and leads a global team of investment professionals. George chairs the Asset Management Operating Committee and also serves on the Asset and Wealth Management Operating Committee. Prior to his current role, George held a number of senior roles across JP Morgan, including building out the mutual fund business, overseeing global funds and the institutional client business, and running the firm's mutual fund joint venture in Japan. He also served as the chair of the Investment Company Institute from 2018 to 2021 and remains on the board today. George is also a proud alum. He received his bachelor's degree in poli-sci and economics from WashU. As a father of 5, including 2 daughters, George is passionate about diversity, equity, and inclusion. He's the executive sponsor and co-founder of JP Morgan's Men as Ambassadors program, a chapter of the firm's Women on the Move Alliance. George is also the executive sponsor of the Asset and Wealth Management Black Leadership Forum and chairs the Black Managing Director Roundtable in Asset Management. George will be joined by Mona Mahajan. Mona is a senior investment strategist on the investment strategy team at Edward Jones, where she helps develop and communicate the firm's macroeconomic and financial market views. Mona appears regularly on financial media, including CNBC and Bloomberg, has been featured in print media like The Journal and Barron's, and she holds bachelor's degrees in finance and computer science from the Wharton School and the School of Engineering. With that, I'd like to welcome George and Mona to the stage. There.
Welcome.
Thank you.
So George, this is such an honor and a pleasure for you to join us today. And really, you know, we always talk about good timing for panels like this. I don't think we could have timed this any better. As we talked about just about an hour ago, we did get perhaps what was the last Fed rate hiking decision. They did raise rates by 25 basis points. We'll get into all of that, Fed, markets, economy, asset management industry. But before we dive in, I thought I'd ask you, what does it feel like to be back at NYU, sitting in Emerson Auditorium? Any kind of memories or insights that are evoked from your time here?
Yeah, great. Well, thank you, Mona, and it's great to be here. What an amazing campus! It is so beautiful. What an amazing spring day. I always enjoyed the spring end of the semester. I think last Friday they had walk-in lay down here, which is a concert in the quad. I always enjoyed that. Marked the end of the semester. I enjoyed my time here immensely. One of the things I was also thinking a little bit about is when I first I joined the outing club, which I understand today is like one of the most popular clubs on school. It wasn't when I was here, and I actually served as president of the outing club for the last 2 years. And the thing I loved was spelunking. And Missouri has some of the best caves in the world. I don't think I'm ever going to go and spend 2 or 3 days in a cave ever again. That was maybe a little too much, but it was great to be back here and fun to enjoy some of the memories.
Amazing. And that is a great hobby, splunking. It's something you do in college days, I think, though, yeah. So we can dive right in, and I thought we could start with the most timely topic, which is, of course, the Federal Reserve. And, you know, since March of 22, the Fed has raised rates 10 consecutive times, bringing rates from really the zero bound to about 5.25% in a very short period of time. The question really is, one, where do you see the Fed going from here? Are they done? Should they pause? And two, markets have started to price in now rate cuts as early as the September time period. Is that premature in your view? And I'd love to hear any insights there.
Well, one thing I think is important for us to like emphasize on this is how dramatic this tightening is. This is probably the most aggressive monetary tightening in my lifetime. We have already begun to see the impact of that. And, there's an old saying, when the Fed hits the brake, stuff goes through the windshield. And some stuff has gone through the windshield and started last year, right? And you've seen that in prices for long duration assets, the end of growth at any price, the bursting of a speculative bubble, SPACs, meme stocks, yields on government bonds, crypto.
Yeah.
And then this year you began to see the second derivative impacts of rate increases. I don't think anyone thought, maybe we'll talk a little bit about it, that would have impacted the U.S. banking sector, which people had assumed was in much stronger position than in the great financial crisis. We expected a 25 basis point hike, and that's what we got today. And very importantly, we saw a change in the language relative to the committee's anticipation of future hikes. The wording is quite subtle in determining versus we anticipate, which was the prior language. So the Fed is clearly signaling that they are pausing rate hikes. Now, some will argue, and I think there's some in our firm that believe that maybe they've gone too far, and we haven't seen the full impact of the rate increases yet. We'll probably talk a little bit about inflation, and you have a lot of drivers in terms of what the Fed is looking at. Clearly, inflation is one of them, and we see inflation moderating. We see a tightening of credit conditions. We've seen slight slackening, maybe slackening isn't the right term, but a moderating of wage growth. And I think all of that points to an economy that is predictably slowing as a result of this fairly dramatic increase. Now, I think some of the question is going to be around the labor market ultimately. The Fed is going to keep very close tabs and eyes on what happens there. Let's assume that I think we're on a pause. I think the market consensus that there are going to be rate cuts into this year is I don't think is likely. Our view would be coming into 2024, you will begin to see the Fed easing as we see greater indications that the economy is slower. The Fed is very focused on controlling inflation. That is their principal concern at this time.
Yeah. And it's interesting because I think our view aligns with that in that we do think the pause is in place, but we think it's an extended pause, to your point. We don't see rate cuts until one of two things are in place. One, economic growth is meaningfully slower, or two, inflation is meaningfully lower, and meaningfully lower meaning at least headed towards their 2% target. And neither of those are in place right now, which does bring us to the question on inflation and maybe a little bit more in-depth thoughts on where we see some of the cracks in inflation. So of course, good news and bad news on inflation. The good news is we have seen 9 consecutive downward increments in the headline CPI inflation. In fact, we went from 9% back in June of 22. Last reading was 5%. So 9% to 5%, a nice move downward. Of course, inflation is still well above the Fed's 2% target. There are, the Fed buckets inflation, I think, into 3 categories, which is goods inflation, which has rolled over. There is the housing rental part of the market, and that part of inflation seems to be showing signs of cracks as well. But the third part, which is non-housing services or that labor market component that you alluded to, that remains pretty sticky or elevated still. So how are you guys thinking about inflation in depth? Do you see us heading towards maybe if it's not 2%, 3% by year end, and that could get the Fed to then signal potential pivot?
Yeah, I mean, our expectation is that CPI will end the year at probably not materially different from where we are today. 4%. But the impact of rate hikes and some of the other factors have yet to be seen. And I think you'll see a steady decline as we have seen.
Yeah.
It's kind of like a slinky going down the stairs. And we will, approach 2% by the end of 2024.
24. Yep.
But I really think that the key question is really back again onto the labor market. You have not seen a successful soft landing by the Fed since 1994. An entirely different environment than you have today. Unemployment was at 6%, not 3.5%. We didn't have record federal deficits. There's a whole series of other drivers. And while our base case is that only 6% of Americans are in a union. Corporations and employers, despite what we saw during the pandemic, during the Great Resignation, there is very little power in labor in the U.S. So our base case is that you see wage control and then ultimately an impact to the labor into the labor markets, and a significant slide. Though if that doesn't happen, I think that's where you see, upside or downside risk relative to higher rates in order to control inflation. You're not going to have inflation under control until you see slack in the labor markets.
Yep, I think that's well said. And it's interesting. This Friday and this week has been nonstop for us economists, kind of like the Super Bowl of the week. But we'll get a labor report on Friday as well, which will show, of course, the jobs number, but also the unemployment rate expected to stay still at 3.6%. So very healthy, near 50-year lows, so multi-decade lows in an unemployment rate here. It's that wage growth figure I think everyone is watching, because that is really the kind of indication of where inflation may be headed, especially on the services side. So the Fed would like to see, I think, a 3.5% wage growth figure is what they've said, probably still somewhere around 4.25. So we'll be watching as well to make sure that continues to head in the right direction. Although good for anyone out there who is seeing an appreciation in their wages. So next question, of course, hand in hand with the Fed and inflation, they now seem to have a second battle, or at least a second line of sight in front of them, which is this banking turmoil that has emerged over the last month and a half or so. In addition to SVB, we had just last week, and perhaps you were even engaged in some of the discussions there, First Republic was acquired. A lot of the assets were acquired by JP Morgan. Could you kind of share where you are seeing the banking sector right now? Any insights? And in particular, one of the things that has come up from an economic perspective is this banking turmoil serves somewhat as a de facto rate hike. It does serve to tighten lending standards. So banks may be making it a little bit more difficult for both consumers and corporations to borrow. That trend had been in place even before this banking turmoil arose. So now with the banking kind of turmoil in place, do you see it kind of continuing to go down this tightening path? And what are some of the impacts or insights you can share with us on that front?
I mean, who would have guessed that the next crisis would have started with Silicon Valley Bank, which was one of the most successful, fastest growing financial institution in the United States. And you think about what's happened, 3 of the 4 largest bank failures have happened in the last month and a half.
Amazing, yeah.
And you come and look at SVB, a well-run, we thought, organization that was serving particularly the tech and venture capital community. But they had a little bit of a problem. One, they grow very, very quickly, and the peak of their growth came at the lows in interest rates. And they invested the growth in their deposits, which approached $250 billion, in long-term government bonds, and seemed to forget about interest rate risk. the inverse relationship between interest rates and the price of bonds. And this is like, it's just an important message for all of us. Managing a bank balance sheet at $25 billion is significantly different than managing it at $250 billion. So most large banks have a very active hedging strategy. SVB did not, and interesting, regulators were incredibly focused on credit and lending standards, and what happens in the event of a recession or unemployment, but we're not stressing interest rate risk for SVB. The other big message, and this goes back a little bit to some of the unfortunate issues with community or regional or smaller banking, is that it was a very undiversified set of depositors, very smart depositors, sophisticated, and therefore moved incredibly quickly. $42 billion in movements and deposits in less than a day. And then that actually translated to Signature, which had very similar issues, very narrow, sophisticated client base that moved very quickly. Then you come to FRC, which had a very different set of problems, which was they lured very wealthy clients using very attractive rates for mortgages and deposit, for mortgages. As a result of losing $100 billion of deposits and overnight, and their stay of execution was slowed by the fact that a number of banks put $30 billion of deposits in. And I think these three institutions share a similar set of issues, which was a sophisticated, narrow, undiversified set of clients. And so you can draw the line there relative to the other regional banks. Most of them have much more diversified depositor base. Most of them are their credit reserves are quite strong relative to the commercial property exposure, et cetera, et cetera. Now the difference is, and I think this is something that we will learn from, is money just moves much faster today than it ever has. 15 years ago, you did not have the tools that investors have today with their phone to move money with a click of a button. And that would be the outstanding risk that exists with some of the other financial institutions. I'm not saying it is an issue, but this is where the banking industry is a confidence game. And if you lose confidence in a financial institution, given the speed at which money can move, that is an issue. Now regional banks do have significant exposure to the commercial real estate market. They are the majority of the lenders to commercial real estate. And so we would expect, as there's been $250 billion of regional bank deposits that have moved to money market funds. And that means they have less of ability to lend those deposits into the commercial real estate and other sectors of the regional economy. So this is going to create a further credit contraction, assuming there are no other failures. That, as you said, is serving as another break to the economy.
Yeah, well said. And I think, in addition to the credit tightening implication, the other one may be the Fed looks like it is going to impose additional regulation on regional banks as well. So that, I think, will be slower to roll out, but something we may see coming in the next 12 months or so, which I think will hopefully serve to add some confidence to the system, but maybe a little bit more regulation as well is needed there. The bigger banks.
The other thing, just in terms of risk to the economy, if rates move to 6, the implication that has to, one, equity market valuations, long duration assets, and some of these sectors of the financial service industry, which may be, in fact, another constraint on the Fed in terms of further rate rises, in terms of systemic stability of the financial system.
Yeah, that's a great point, because I do think, and we'll talk about where you see the biggest risks, but I think one of them is if we have to keep going on this tightening cycle, even though people are hoping for that pause, there is that tail risk that actually inflation starts to reemerge once again. So speaking of credit conditions tightening, a banking system that's softening, my next question is around the big R word. Anyone here guess what that might be? You guys are smart. I heard it. So it is recession, in fact. And specifically, we've now seen even the Federal Reserve call for a mild recession here in the US. If you look at Bloomberg consensus estimates, in fact, Q3 and Q4 are calling for slightly negative GDP growth rates for 2 consecutive quarters. Where does your team, and maybe yourself in particular, stand on whether the economy will enter a recession? And importantly, do you think it'll be deep, severe, or shallow and maybe quicker?
Our base case is a recession. I think that is a consensus. As I said before, given how aggressive monetary tightening has been, even at the beginning of this, it's almost unfathomable that you would have a soft landing. And in most circumstances, the Fed has not been able to land the economy without a recession. And I think we see that play out. To your point, it's really not a question of if, it's a question of when, and what is the duration and depth of the downturn in the economy. And by the way, shouldn't surprise a bunch of people. This is kind of the market, this is the way economies work. And this is a business cycle. We're at the end of a business cycle. Our view, and some of it may be hopeful thinking, is this is a relatively shallow and short recession. And then the question on top of that is what impact does that have on earnings in terms of the depth of an earnings reception? Corporations in the U.S. have been able to basically use margin adjustments in order to avoid that. But we will see how that plays out.
Yeah, and very fair point on the earnings recession that we're starting to maybe already be in Q1 and Q2, and that could be followed by maybe an economic recession. And then, of course, as we head from the economic cycle, we start to think about the market cycle and how financial investors may be impacted by this. And of course, last year was challenging, a 25% drawdown in the S&P 500. It wasn't only equities that were down. The bond market had its biggest drawdown in history as well, or one of its biggest drawdowns in history. So if you're a balanced investor, you had a 60-40 portfolio or exposure to equities and bonds, there's really no safe place to hide. This year, we're starting the year on a slightly better note. The S&P is up about 7%. Bond market has rebounded as well as treasury yields have fallen a bit. But it does seem a bit fragile. It's, the equity market returns are based on a very narrow set of sectors that are leading. In fact, a very narrow set of companies that are driving a lot of those returns. And meanwhile, it could be also driven by valuation expansion as the E, as we noted, and the PE ratios are falling a bit. So, that kind of brings us to the big question.
By the way, I mean, recessions are painful because it generally involves, as we said, unemployment, and that has implications to people and families and society. As investors, these market cycles create huge opportunities, and it's the over and undershoot that create opportunities for active management, tactical asset allocation. So as we look at it outside of the human factor, we see this as an opportunity. And we've already seen that play out quite significantly relative to opportunities in the bond market. And we'll talk, I'm sure we'll talk more about that. But I think it's just keep in mind that this creates opportunities for us to exploit the inefficiencies that'll be created by the over and undershoots that we see.
Yeah, and exactly the direction I was headed. So, where do you see some of the biggest opportunities emerging across asset classes? And if there's one or two that you really like and feel like, have high conviction in, love to hear any thoughts around it.
Well, you go around the world. If you look at U.S. equities, I would say they are still, even despite the last year's returns, they're still richly priced on standard value, almost every valuation methodology. Small looks better than large. Value looks much better than growth. So you caution with the U.S. equity market and sectors, I think, are pretty good. Now, as you go outside of the U.S., international and emerging markets looks much more attractive. Part of that is the view on the dollar. Some of that is just the performance of the U.S. market historically compared to others and price to earnings and other valuation methodologies. And China in particular, with the reopening, valuations look much more attractive. I was just in Shanghai last week, and it's just amazing how they reopened the economy. It's fully back in action, and you'll see that in luxury market spending. You'll see that in hospitality. You'll see Chinese tourists come back around the world. There'll be a significant amount of spending, and that's going to create opportunities. And whatever the geopolitical issue is, one of the most dynamic economies in the world, and that does offer some big opportunities. And then you have fixed income markets, which are quite attractive. Particularly duration is attractive now with the likelihood that the Fed has paused, and there's some really attractive, not high yield. Kind of coming into a downturn, but if you look at securitized credit, high quality corporate bonds, there's some really good opportunities for active management in that space. And then you look into the private markets. We have not seen a repricing of private markets to the extent that we have in public markets. And so, in the biotech, life science sector, you saw the private markets, venture in public markets impacted by down 80%. It's been tough in private markets, but not to that extent. So we're likely dry powder in private markets is going to be a huge opportunity as prices are reset. But with all of that said, and just a little bit of my philosophy, our philosophy, like the macro views, I think are less informative of the opportunities than really exploiting what's happening at a company by company, credit by credit basis. So, investing is hard work. There are great quant models, and Cliff and AQR has done some great stuff in that space. But understanding the fundamentals of a company, its management, its ability to execute on its strategy, in addition to valuations, are so important. So that's why we employ 300 people, equity analysts, credit analysts. We spend $400 million a year just on research of equity and fixed income. That's about 50% more than our average competitor. Because if you want to exploit opportunities and inefficiencies, you need to have an understanding of what the future cash flows are of a company, the ability to then analyze that relative to other opportunities. And that is what we are spending all of our time doing. Of course, we have views on the macro side, but that is so important. And so just a couple of things I'll just mention in terms of product capabilities that might be interesting relative to that. Because despite being very difficult market, there are some ways that you can take advantage of it. So we have, it was in the Wall Street Journal yesterday, the largest active equity ETF in the world called Equity Premium Income, JEPI. It invests in defensive stocks on an active basis, uses an option overlay to generate income and reduce downside risk. Over the last 12 months has generated a yield of roughly a little over 11%, in addition to getting exposure to 70 to 80% of the upside of the market. And then you have that yield as a cushion to downside. We've applied that exact same model to NASDAQ stocks, which is called JEPIC, JEPQ. And I'm just using this as a way to get some ideas that it's not just exposure to the underlying markets, the way that you can package and pull these capabilities. The other thing I think is a huge opportunity is unconstrained fixed income investing. And that's probably going to be important in this next cycle. There are segments that you want to stay clear of. There are others that are quite attractive, and the ability to rotate in and out of those.
Yeah.
So our unconstrained fixed income, global bond opportunities, others are a big thing. And then, of course, into emerging market, which is, for long-term investors, volatility will be significant, but the long-term opportunities, I think, are, and this is not a bad entry point.
Yeah, that's great. And it's a great kind of summary of how, because a lot of young investors, especially, I think, get kind of paralyzed as to what should I buy? How should I start investing? And so some of those names and tickers you just listed, I think, are just a great place to start putting dollars to work. And of course, as we know, the younger you start, you really benefit from that power of compounding. And so really just getting exposure, especially after a bear market, that is, providing a lot of interesting opportunity and entry points. So important to just kind of start regularly putting that money to work and getting it to work for you over time. So appreciate those kind of insights as to where you could start thinking about it. And then, of course, you alluded to international, and specifically, I'm curious on your views on the US dollar. We've also heard some rumblings recently that some BRIC economies may want to start a competitive currency, especially for petrodollars. We've also seen, last year the dollar had a very nice run, nice appreciation as the Fed was raising rates rapidly. This year that's reversed a bit, and really since October we've seen a little bit of softening in the dollar. Where do you see the dollar going, and do you see any credible threat to the dollar as kind of the reserve currency of the world?
It's funny you say that, because my son, who's a student at Northeastern, sent me a note the other day, and he goes, "Dad, the U.S. currency is dead. The BRICS are going to take over."
It's in the headlines.
And it's funny because a year before that, he sent me a note and said that Bitcoin had traded below 35,000, and could he borrow $500 to invest? I said no. And that you need to understand what the intrinsic value is. I'm not sure you know what the intrinsic value of Bitcoin is. And listen, I think this is, it comes back to a little bit the over-under truth. The dollar was a period of dramatic strengthening over a period of time. It overshot. It is overvalued on most measures. Purchasing power parity, et cetera, relative to other currencies. There will be a period, I think, of dollar weakness for the foreseeable future. You've seen what that's done to returns year to date. International's outperforming the U.S. 7%. Asia is outperforming Europe, and 1 or 2 points of that outperformance is coming from the weakness of the dollar. And that's also gonna help foreign companies. And so I don't personally. I know there are some that believe that the dollar is under attack as the reserve currency of the world. I don't think that's likely. It's potentially possible. And I think there's a great deal of interest that the world and the U.S. has in maintaining the dominance of the dollar.
Yeah, absolutely. And one thing we point to is really the U.S. is the only place with such deep and liquid capital markets, both in fixed income and equities. But really, there's no one that comes even a close second. So it does feel like the position as the reserve currency of the world is protected just from that perspective. So interesting to
stability in our political and economic system, however, would further support the dollar as the reserve currency. And I think that's one of, if there was one risk that sits in front of us that is probably maybe the least likely, but also would have the most dramatic impact, is the debt ceiling. And Yellen's announcement 2 days ago that what people thought was the beginning of August until the Treasury ran out of money, which is now apparently June 1st or June 5th. And given the political gridlock, I guess that's one way to put it, that we have in Washington today, we are going to come right up to the precipice. Yes. And a mistake would be incredibly damaging. on a number of fronts. So I have confidence in our political system that we will go to the precipice, but then not go over the edge. But I think we need to keep a very, very close eye on this.
Yeah, it's a fair point. Usually it's a political dance until the last minute resolution comes into play, which hopefully will happen this time around as well. And that actually is a great lead into the next question on risks. And of course, there's probably numerous you could point to, but are there any one or two risks you worry about on the horizon from your asset portfolios? And we'll talk about more risks and disruption to the industry broadly after that. But curious on risks to.
Well, I mean, I think we've the debt crisis,
ceiling,
this debt ceiling is obviously the biggest on my mind at this moment. There is the potential that we have overshot in terms of monetary policy and over tightened. When I grew up at J.P. Morgan, I worked there for my entire career in a training program. They had this Scottish professor who came, and you won a bottle of Macallan's, 18-year-old, for the team who won. You were divided up in teams of 4, and you ran the U.S. economy on a computer. So you were the Fed, and we blew up the economy like 5 times. And it always came to easing too quickly or tightening too aggressively. So I do think that is a potential issue, and having I think the biggest damage to the economy would be not a recession, but a slow grinding long recession. Either quick and deep, or quick and shallow is better than a long recession. And I said again, the other big one, because I think in these things you need to think about every eventuality. Maybe we haven't tackled inflation, and if rates go to 6 or 7%, we are in for a very difficult time.
Yes, I think that last one you mentioned is one that's on our radar as well. If we do have to, we're hoping 5.25 and pause, but if we have to kind of revisit rate hikes once again, I don't think the market is priced for that, and certainly may cause some disruption. So knock on wood, prices start to continue to go down.
I mean, remember, this is like an important one just to think about it as like probably take it through your life. This is the end of free money.
Yes.
It's a fundamental change in the world.
Yeah.
And you saw it last year, right? Holding a growth company that is unprofitable with the expectation that over some period of time, it's going to grow quickly and revenues are going to grow. That once you apply 5 times higher cost of capital to that business model, and that has not come through the entire economy yet.
Yes. Yeah, that is an excellent point. And in fact, you bring up a great point in that now there is an alternative to putting your money in equity and bond markets, which is, I'm sure, many of our clients and many of you guys might have thought about CDs, money markets, all offering interesting yields. And of course, as we look through the next 10 years, will the Fed go back to the zero bound as it did after the financial crisis? Unlikely. So probably a better balance overall between, value and growth and all of that. There is an alternative. You have just better diversified portfolios, hopefully overall. But great point on that. So, that kind of brings us to, we talked about markets, we talked about the economy. I'd love to get, you have 4 decades of experience in the asset management industry. What are your thoughts there as to, one, do you see any evolution in the industry that you're excited about? Do you see any disruptions or risks emerging to the asset management industry that you're thinking about as well?
So one of the risks that people talked about is that the technology companies would come to the banking or the asset management industry.
The AI.
I think that's less likely now, given what's happened with the bank failures and the fact that these are heavily regulated industries, and would add a whole degree of complexity. Listen, I think there's 2 things that will not change in the asset management business. particularly as an active manager. I think it's true of the entire industry, which is outcomes and investment performance is the most important thing. If you can't add value or live up to the promises that you've made, it is an incredibly competitive industry, and clients will go elsewhere. Trust, long-term stability, investment performance is like fundamental to the model. And it's interesting because it creates a little bit of a dichotomy, right? On one hand, our constituents demand that we are stable, that we don't change. A change in a portfolio manager or an investment team is seen as a way to put a manager on hold or to move assets elsewhere. On the other hand, the world is changing incredibly rapidly. You all know it. We see it in every sector. We see it in every industry. And if you don't adapt and change your business model, you have the potential of becoming irrelevant over time. And we all know all of the examples in other sectors where that has become an issue. And at the front of it is technology in my mind. I think asset management has been historically a slow adopter of technology outside of trading, which has been linked very closely to the sell side and the broker-dealer community. And we, in my business, we have 1,200 engineers. We spend $500 million a year, and we know that we have to be a technology company in order to improve and iterate on our investment processes, our form of distribution, our servicing of clients, and we are using every capability in order to do that. Large language models, artificial intelligence. We're developed something called Moneyball, where we're using the behaviors of our portfolio managers and researchers to help them understand when they're early, when they're late, what behaviors add value and performance, which do not. The opportunity to have the machine go out and read tens of millions of disclosure documents, earnings transcripts, and then use that as a flag to deliver to the human, who then can do further research and further capability. So I think technology is at the forefront of everything, and I think it's quite interesting because I don't think people and maybe students today and everything understand that the asset management industry is becoming quite dynamic in this regard. The other thing that's happening with technology is the potential of entirely disrupting the industry. Mutual funds. Why do you need a mutual fund if technology can replicate that at a personalized basis for each individual person? In terms of taxes, in terms of your preference of social issues or environmental issues. Why do you need an ETF? And while I don't think that's imminently going to happen, I think being able to use technology, and we acquired a fintech firm in Boston that's using tax optimization and tax transition strategies, algorithms that support and enhance our active investment strategies. The other thing that we're doing is, I don't know, everyone thinks the world is passive and you're better off getting average returns and fees are everything. I tend to believe that ultimately we all are competitive people and want to have the ability to outperform, to find opportunities that are differentiated and add value over time. So when we look at the ETF marketplace, which has become one of the fastest growing segments of the industry, which is almost 95% passive, cheap beta, we've taken our best ideas and incorporated it into the ETF structure because it does have some advantages relative to mutual funds. Taxation is one of them, and frankly, ease of use is the other. Being able to enter a ticker, buy and sell any time of the trading day, and I think this is a really exciting opportunity for the industry.
Yeah. That's great. I'm glad to hear that there's still going to be humans involved in this process. So we maybe have some job security for a few years. So that's good to know. One thing that I find is that helping clients navigate market volatility. It does feel like sometimes you're not only a financial advisor and someone that provides acumen and thought leadership, but also almost like an emotional psychologist, especially for newer investors who haven't been through bear markets or haven't seen the type of volatility we've seen more recently. So how do you kind of think about helping clients navigate that short-term volatility, but kind of keep their eye on that long-term financial goal they have in place? Such a critical role in the asset management industry.
Yeah, so our business model is we are a B2B, right? We work exclusively with Edward Jones, financial advisors that work as an RIA, independently, a range of professional investors and advisors. And we consider our job, and one of the things that we've really tried to do is managing money is the core. We have to have strong investment performance. But how do we deliver resources, tools to financial advisors to help them communicate and navigate in the market? And we've done a whole series of things. One is called Guide to the Market. It's a fact book. I have one here somewhere. It has roughly 50 to 60 slides, and it doesn't state a view, but it does, on any question relative to the ones we've talked about today, provide the facts of what's happening. Yeah. So in 2008, when you saw credit spreads gap out dramatically in high yield, it was a once-in-a-lifetime opportunity to invest in high yield, and being able to explain that through objective data and information, we think is incredibly powerful. It's been one of the reasons that we've been the fastest growing active manager in the world, is being able to help advisors do that. Now the question is, how do you translate that into the next set of things that are of value to people? And this question around portfolio construction, asset allocation, 60-40, what should I do? We developed digital tools where a financial advisor and even an end client can upload their portfolio, run it through the same systems we run for managing a balanced portfolio, and provide a series of observations that people may not be aware of, looking through to the underlying holdings of the funds that they have. And then there's a whole series of next iterations on these capabilities. And I think it's one of the things that we're kind of known for, of providing objective information to help people use facts, not emotions, to make decisions. And that's the biggest challenge that any investor has, no matter how sophisticated you're. And I thought Cliff did a great job of making that point.
Yeah, absolutely. And I know you guys are a great partner for us. And one of the tools that we use, I don't know if you may have seen this one as well, but it's called Missing the Best Days. And it's emotional resiliency. But if you think about, you'll go back over any 30-year history of your portfolio, if you miss just the 10 best days in the market, your portfolio returns get cut in half. And it gets progressively worse as you miss more and more best days. But what's interesting about that is a lot of those best days occur during crisis periods, whether it's a financial crisis or the pandemic period. Those are the times you feel like you want to sell portfolios or maybe make some changes to your portfolio most. But in fact, those are the days that you probably want to stay invested. And a lot of those best days actually occur within 10 to 15 days of the worst days. So just interesting factoids that we kind of turn to kind of advocate for staying the course even through volatile markets. So
we have a number of programs we had, and this was during the financial crisis in 2008, 2009, it became incredibly valuable, which was systematic rebalancing. And essentially what that does is, in market moves where markets go down, you tend to buying into weakness. And that's something that's very difficult for an individual to do. Market goes down 500, I'm going to buy the market. And sometimes these systematic programs, and that's why programs like investing $100 every month is a very valuable way of doing it as well.
Yeah, takes the emotion out of it. So dollar cost averaging, as it's also known as.
Yep.
Now, one of the things about the future of the industry. Is there anything that really excites you out there as we think about maybe the next 20 to 40 years in asset management? And I know we touched upon some of them, we alluded to some of the new and exciting things, but any one or two things that you can point to as we are wrapping up our final couple of questions here today?
Yeah, well, one, I would just, I mentioned that I was in Shanghai last week. We have had a joint venture in China for 19 years. And earlier this year, we got the approval to acquire 100% from the Chinese regulator of China International Fund Management Company. And a couple of weeks ago, we acquired the full company, and I went to do a rebranding ceremony and meet the team. We now have 400 JP Morgan Asset Management employees in Shanghai, 100 investors, portfolio managers and researchers that added to the 8,000 employees in JP Morgan Asset Management and the 1,200 investment professionals. It's a tricky situation. I mean, you all know what the geopolitical situation is, but I mean, China is the second largest. I mean, we all know this, but sometimes you kind of just need to remind yourself. It is the second largest economy in the world. It is the second largest capital markets in the world. The largest debt issuance over the next few decades will be by the Chinese government and by Chinese companies. It can't be ignored. Is one of the most dynamic economies. In Shanghai, if you walk across the street and you jaywalk, through facial recognition, they will identify who you are, and then they will debit the fine in your WeChat account.
Wow.
So, I mean, some of that's a little scary, but it does show you like the advancements in some of the technology, so we have to, in order to help our clients navigate multinational companies that are doing business in China, new opportunities that are going to arise, we have to have JP Morgan insights on the ground in China. And I think it's a huge competitive advantage for us to do that. The other thing that's truly amazing, the wealth creation in China, the mutual fund industry the first mutual fund was launched in China 25 years ago. Today, it's a $4 trillion market, an astronomical rate of growth. And what's different is in the US, 1980s, the 401k was launched. Why is that important? Because any investor you talk to today, Main Street investor, their first experience in managing money or investing in a mutual fund came from their company 401k plan. That's how people learn. That's how we developed an investment culture in this country. And that's where you see almost one-to-one correlation with the growth of the mutual fund industry, the asset management industry, is the growth of the 401k industry and its adoption by companies. So to see that type of growth in China, and it is a very immature market, the asset management industry is incredibly speculative. People judge performance over 6 months, not 3 to 5 years. And I think as the economy matures, as the pension market matures in China, it's going to become the largest asset management market in the world.
Yeah, that's a great call out. And in fact, having a trusted partner like JP Morgan there probably helps alleviate some of those concerns for investors who were maybe worried about putting money to work in China with an unknown entity. So I think that's a great call out. I know similar story in India as well. The asset management business is in nascent stages, lot of growth.
What's the most expensive equity market in the world?
Is it India?
On a valuation basis. That doesn't mean it couldn't get more expensive.
Yes, exactly. Things tend to go up before they correct themselves. Well, good. I think we're at the close towards the last 5 minutes or so of our session, but I could not leave our talk today without asking you a little bit about, we're sitting here with a somewhat younger group who are going through the business school process, who are thinking about their careers ahead of them, is there one or two pieces of advice that you would give them? One, on how to enter the asset management business if they're interested, and two, any just career advice in general, so they could potentially have as successful career as yours. And I'm happy to give one as well.
Yeah, I think. Listen, I mean, I think you're going to see a tidal wave of wealth be generated and come into the asset management industry over the next couple of decades. This is a growth industry. I think some people have seen it as sleepy. I will tell you that it is incredibly dynamic, and helping people save and invest for the most important moments of their lives is significantly more rewarding than building apps to help people buy more stuff. So I think it is a great career, and it's not just about being a portfolio manager or analyzing companies. It's about building technology. It's about sales. It's about marketing expertise. We're doing some really cool stuff in marketing. It's very cutting edge, and it changes the ways and the types of people. So there are lots of different entry points. There are lots of different ways to be successful. I was political science. Here I had very little interest or understanding about the finance, and now I am the CEO of JP Morgan Asset Management. So anything is possible. And I would say the other thing I would say, just in terms of advice, and I gave this advice to my daughter Eva, who's here at Wash U. She's hopefully studying for her finals right now. There are a couple fold. One is failure is the things that go wrong are where you learn. And I think it's incredibly important to be able to expose yourself to enough risk to make bad mistakes, learn from them, pick yourself up, dust yourself off. Doing things right, you tend not to learn. And that also, if you also are always going to get things right, that means you're not going to take enough risk to have the impact that I think that you want to have in your life. The other thing I would say, I have a saying, which is squeeze the light out of day, which is it's short, the time that you have here, and taking full advantage of it means that you really have to step forward. And I know people are doing that too, but sometimes it's good to just remind yourself of that. You've got to take full advantage of this incredible opportunity that you've been afforded.
100%. And that's great advice. And one other I'll add, which goes along with that, is your career tends to be a marathon, not a sprint. And I do find that, especially when you're younger, you want to get to the end game faster. Well, you really have 30 to 40 years ahead of you to get to the place that George is, or even here where I am as an investment strategist. And trying to find what you're passionate about, I think, really is helpful along the way. So that whether it's the work, the people, the cause, anything that kind of keeps you going through that marathon period, I think is helpful.
I think that's totally great, the patience, and this is a long road you need to do it. I have another saying, which is maybe the other side of that, which is mountaineering is one of my great passions. And I was saying, which is, in mountaineering, which is speed is safety. The faster that you get to the top of the mountain, the more likely you're going to get down safely. You're going to avoid a rock fall or an avalanche or a big storm. And I think it's this thing about, like, if you're moving in generally the right direction and you're thoughtful and disciplined around it, keep moving. Don't stop, because you got to get to the top. Motion is very important thing.
Love that. So sprint for a very long time. But thank you so much, George.
Thank you, everyone.
It's been wonderful. Thank you guys for being a great audience.